Welcome to La Trobe University. My name is Libich, and I'm really thrilled to be able to welcome Professor Adrian Pagan from the University of Sydney. Welcome, Adrian. Thank you for coming.
Well, thank you very much, Jan. And as Robert Frost once said, hell is a half-filled auditorium. Well, we have a complete auditorium here today, so I'm very pleased that you could manage to arrange that.
Thank you. I should also welcome my third-year monetary policy student. Thank you guys for coming. And today we're here to talk about a real-world monetary policy. So none of that boring stuff that you can read in textbooks, but Adrian experience and expertise in real-world policy making as a former member of the board of the Reserve Bank of Australia, I think qualifies you to talk about the real world and how real-world central bankers conduct their policy. So let's start with the big picture. Let's start with the goals. What is it that central bankers are trying to achieve in terms of monetary policy?
Well, I think that's not an easy question to answer. If you look at the foyer in the Reserve Bank, you'll see a statement from the Reserve Bank Act, which is all about the Reserve Bank's objective is to preserve the stability of the currency, full employment, and manage the prosperity and welfare of the Australian people. Well, with those sorts of objectives, it's pretty clear that anyone could satisfy them with any sort of definition. So you need something more, I think, than that. And I think in practice it often comes down to something involving a rate of inflation, something involving a rate of growth, and basically some other constraints that at various points in time might actually be more relevant. I think when I joined the board, for example, there was a lot of discussion about what the potential rate of growth of the Australian economy was. At that point in time it was regarded as 3%. And in fact, today it's regarded as 3%, as you can see from various statements by the Treasurer recently. And during the 1990s, though, when I was on the board, we had large growth in productivity. So the sustainable growth rate at that time probably was higher than 3%. And a lot of discussion was about, was it 3 or was it 3.5? Of course, that affects what you think you can do.
So basically, many countries in the last 2 decades have implemented inflation targeting. They announced, they legislated a formal inflation target, and I think one of the reasons is precisely what you're saying, that the rate of growth or the natural level of unemployment is changing over time. So you can't really have a numerical target on that level, but you can have an inflation target announced. Is that correct?
Well, I think that the point of inflation target, I think if you go back and look at a lot of the minutes of the monetary policy makers, you'll discover that everyone had a different opinion on what the target was. And you sit around and someone's got the target as 6%, someone's got it at 1%. It's very hard to get a consensus on what monetary policy should be. One of the things I think has been fantastic about inflation targeting is it focuses the mind wonderfully. You don't debate what in fact the rate of inflation target is, you debate how we get there. And I think that actually has had an enormous impact upon, for one thing, how long these meetings actually lasted. The Reserve Bank meetings used to go for a whole day. When I was there, they eventually went from about 3.5 hours, and I think today they go for 2 hours. And I think a lot of that was to do because there was very precise targets actually, and it does help to have that.
So how do we actually achieve this? What's the transition process as seen, through the lens of a central banker between some kind of decision and how it translates into the economy, into the rate of inflation or some kind of level of growth?
Well, I think every central banker probably has a different view of this. There are obviously direct effects. You raise interest rates, they have direct effects upon expenditures. If you raise them enough, they have enormous effects on expenditures, as we saw in the end of the 80s and we saw in 1974. But there's also an awful lot of indirect effects. Some people emphasise confidence. They talk about interest rates are important for confidence. Other people talk about the effects on asset prices. Other people will talk about the impact on liquidity and money. And I think they're all part of the transmission mechanism, but some people give bigger weights to one than to the other. And the Europeans, for example, have always been very focused on monetary issues. And in an open economy, for example, you'd also be very interested in the impacts on the exchange rate, because the exchange rate has a tremendous impact upon activity. So all of these things have to be brought in, and I don't think there's just one transmission mechanism. There are lots of them, and people just put different weights on them.
Now, in terms of you mentioned Europe, and there was always the Bundesbank's view that they have this two-pillar policy. They don't just look at inflation, but they also have a monetary target. And prior to the crisis, many people have been critical of this because sometimes these two pillars were in contradiction. But I think the crisis, and we will talk a lot more about it later, has shown that they were probably right in not ignoring money as most other countries have. The role for the monetary aggregate kind of seems to be more important than what is captured in new Keynesian type of models where money basically doesn't play any role at all.
Well, I think that's true of a new Keynesian model, but I don't think that central banks have ever ignored things like liquidity or even things like credit growth. I mean, when I was on the board, one of the things we looked at a great deal was how fast credit was growing and whether that would actually ultimately have an impact on aggregate demand and therefore upon what the inflation rate would be. Mm. I think that the simple models always ignored it, but the types of models that central bankers have to use, it never really ignored them, although I think they downplayed it. And one of the reasons they downplayed it was that if you take the Australian experience, for example, in 1974 we had a credit crunch and all the models were adjusted to have thousands of equations essentially to capture the behaviour of banks because of that effect, and 10 years later they dropped all the equations because there'd never been another one. And it's always like that. I mean that money and credit has always been there, but sometimes you downplay it and sometimes you don't.
Well, one of the periods where it was certainly downplayed was prior to the global financial crisis in the early 2000s. If you look at credit growth, it was pretty much 10-15% annually in most countries, and central banks were very focused on CPI inflation, so they largely didn't respond to that, and we now seem to agree that was a mistake. But let me just, so if I was to summarize the transmission between the policy actions and the effect on inflation, the rule of thumb would be, if inflation deviates upwards from the target, we would need to raise interest rates. If it goes downwards, we need to lower interest rates. But the implementation is kind of tricky, right? Because there are lags from the policy decision to the effect. So in the real world, Svensson calls it inflation forecast targeting. You tend to look at your forecast and try to react preemptively. Can you maybe just outline how this thing works in the real world?
Well, I think it's very much like driving a car. When you drive a car, there's no point just looking at what's happening to the guy in front of you. You always have to be thinking about what's going on into the distance. I mean, is someone in fact coming in from a side road that you have to worry about? And therefore you have to be focused on not something that's immediate to you, which is looking at what the inflation rate is today, but what you think the inflation rate is going to be tomorrow. Mm. And the reason why you have to do that with a car is it takes a long time once you put the foot on the brakes. It just doesn't stop immediately. What you can't do, of course, is when you're driving a car, and it's similarly true, I think, for central banks, is the guy who suddenly comes in from the right and goes through a red light. I mean, that you just have no idea this is going to happen. And that would be called a shock, because it definitely would shock the car and you. But that's the sort of thing macroeconomics is about shocks and the responses to shocks. And in many ways, I think this there's an art to monetary policy, and it's essentially an art in learning what are the likely shocks, and am I seeing them happening now, in order to work out what types of adjustments you actually want to do. And some people are very good at this, actually. Some of the people I've sat with on the Reserve Bank board were extremely good at it, in fact.
Well, my students seem to have improved their skills along this respect, because we play this simulation game where the student is like the governor of a central bank that has some data on inflation and so on. It was developed by a Swiss economist and Ivan Langwiller, and you basically just change the interest rate based on the economy. It's calibrated to US data, so there are shocks that you have to try to forecast as well as use all the theory. So they know that it's hard. But some shocks are kind of harder to stabilize than others, especially supply shocks. So how do central banks generally respond to supply shocks that move inflation and output in opposite directions?
Well, I think there's a great variation in this around the world. Some people actually write into the remit that the central bank has a clause which enables you to discount certain types of shocks. I mean, particularly oil price shocks, or for a country that's very, very sensitive to oil price. Others require the central bank to actually make a statement about why they ignored it. I mean, a written statement to the authorities.
That's the UK.
That's a UK case, and other, in other countries, basically, I think it just becomes a matter of the central bank actually trying to explain why, in fact, it can't do anything about those shocks. And we've had a number of those in Australia in the last 20 years. The biggest was the GST introduction. There we had a 6% inflation rate for one quarter. The bank kept on making speeches long before this occurred and making forecasts that we'd get 6% growth, and that they argued, quite rightly, that this should not actually cause any rise in wages. That is what are called the second round effects. That what you don't want to see is a 6% rise in prices due to the GST become a 6% rise in wages and then become a 6% rise in prices and so on. So that was quite successful, and it was against a great deal of opposition. I think one of the unions, I think it was the CMFEU, said that they would have vicious strikes in order to make sure that workers got compensation for that 6%. But most of the people who were doing the enterprise bargains at the time in the unions, quite valid, actually took the lesson that this was something that was a once-off and it would happen once, and that this shouldn't be built into enterprise bargain contracts. And I think they were successful. I think we have the similar sorts of things with the carbon tax today. I mean, the carbon tax will cause some extra inflation, and the bank's already made some statements about that. We have things where inflation goes up due to floods. We have inflation going up due to cyclones. And all of these things are things that the bank has to basically say, well, there's not much we can do about these things. They're outside of our control. And, and I think that probably that's the most common way people deal with this around the world.
Central bankers sometimes use this terminology of looking through supply shocks, just kind of ignoring them and letting them kind of fade away.
Yeah, they do. You have to be careful, I think, with what exactly is a supply shock. I mean, it's pretty clear with a flood and a cyclone that you have a supply shock. But if you think of oil price rises, for the US, which is such a big economy, to think that that's a supply side shock, I think is not the right way to think of it, because one of the reasons the oil prices may have risen is due to fast US growth. And so therefore it's something that's you can in fact sort of affect. I mean, if you're a big enough economy. We can't affect the price of oil, so if oil prices went up here, then we wouldn't be able to do anything about it. But so you have to be careful about whether you can do something about it or whether you can't.
So basically, just to summarize, you're saying that some shocks are not genuine shocks, but they might be endogenous to policy.
I think you have to think about that. I don't think cyclones or floods are things that the central bank has got much control over. On the other hand, GSTs was a policy decision by the federal government, and therefore potentially we had some control over it. But once it's made, then you have to just commit yourself that, and convince people that this is a once-off thing and therefore it shouldn't go any further. And that's very tricky.
So now that we have a kind of rough idea what conventional policy is about, and we'll talk about unconventional monetary policies like quantitative easing a little bit later, let's look at the design, the institutional design of monetary policy. And we've seen some dramatic changes over the last 20, 30 years. We already mentioned inflation targeting, but one of the key changes was the move towards independent central banks. So why did that occur? And what's the point of central bank being independent from the government? And how did that affect your decisions while being on the board?
Well, I think it's not easy to work out why people got independence. The Reserve Bank of New Zealand, I think, was the first one to get a formal independence. I mean, the Bundesbank, for example, has been independent for quite a long time. I think it probably got it because New Zealand was in such a mess. I mean, that people felt that you couldn't be any worse off if, in fact, you made the central bank independent. But in lots of other cases, I think it's not so clear about why you got independence. I think there is a fear that if you leave the politicians to sort of tackle what are difficult decisions, then they'll try to avoid them. We can think of a recent one. If you live in Sydney, it's the second Sydney airport. The Sydney airport has been discussed for 40 years and still hasn't come about because it's not the sort of thing any politician wants to sort of bring in. In terms of monetary issues, we had a great deal of regulation of interest rates in the 70s, and the federal government was very, very reluctant to raise interest rates, even though inflation was starting to take off. And again, that was something that you could see that an independent body might actually do. And I think that was probably the reason that a few of the early ones got independence, and that looked like it was successful, and so it actually success breeds success, so people decided to do it.
Well, it seems like the theoretical underpinning is following the high inflation in the 1970s. The literature identified the timing consistency problem, the kind of temptation of politicians to lower the unemployment rate, and given the short-run trade-off between inflation and unemployment, it seemed like it was possible, at least in the short term. So I think and obviously expectations responded to that and rise. So I think just to close this channel, to make monetary policy more credible, more believable, I think might have been the reason for independence. But it also went hand in hand with other increases in transparency and accountability. So, what is that about? Now central banks publish virtually all aspects of their undertakings. And, in the 80s, you had all these books about secrets of the temple, how the Fed runs the economy and monetary policy mystique. Why does all this move towards transparency and openness? And what were the effects of that kind of development?
Well, the movements, I think the central bank transparency and openness is really just an extension of what was happening with all government. I mean, 30 years ago, we didn't have freedom of information requests. 30 years ago, we're only starting to introduce ombudsmen for all sorts of things. I mean, so, the public service and government in general has become more and more open. In many ways, you might argue that the central banks were one of the last ones, actually, rather than the first ones. And so it's not surprising, I think, that they eventually felt under pressure to release more information than what they actually had been previously. It's said that when Nugget Coombs was governor of the Reserve Bank in Australia, he spent 3 years and never once talked to a journalist. And the idea, when I mean talk to journalists, I don't mean literally personally, but he never ever went out and talked to anyone involving news. In those days you could get away with that, but today you couldn't get away with that. And I think that was probably how it happened. What effect did it have? Well, I'm not sure it had a great effect, actually, apart from...
What about anchoring expectation?
Well, I think the inflation target itself is meant to anchor expectations. Transparency, I don't think, actually does that by itself. One of the things I think, it was a little ridiculous that decisions were made about interest rates, for example, in the 1980s, and they were never announced. So the private sector had to guess what the interest rate decision was, and that seemed rather silly in retrospect.
Well, you had teams of people in commercial banks trying to work out what the RBA was doing. I mean,
that's exactly
costly,
right. Yeah. And, Marty Dungy wrote a thing where they tried to interpolate what the actual interest rate decisions by the bank were. And I think gradually that it didn't make much sense for you not to reveal what the interest rate decision was. And I think so. I think that had an impact in the sense it reduced that level of uncertainty, and which was worth getting rid of.
But there's still some aspects of transparency that central banks differ in. Some central banks are now publishing their forecasts for most variables, but some others don't. So do you think that's a desirable thing for the central bank to publish their forecast?
Well, I'd have to ask you what you mean by forecasts.
Well, okay. Adrian is an econometrician, so this is.
Let me
say the consensus forecast for inflation and output into a few years down the track.
Let me be more precise in my question. Do you mean the forecasts that went to the board?
No, I mean the consensus forecast that the board would want to communicate to the public.
Well, is that the forecast that contains the current interest rate decision? Or does it contain an interest rate path about what they think it will be in the future?
Well, this is obviously a matter for debate. And the RBA, for example, they used to publish forecast with an assumption of a fixed interest rate. And now they basically endogenized it, so they're using the projected interest rate path, and I think that would be the most sensible thing to publish, wouldn't it? Because it shows that the central bank has control over the economy rather than just taking the interest rate as given.
Yes, but if the central bank shows a path, then it should be that by the end of the period, if it's 2 or 3 years out, all you should be getting as the forecast is the target.
That's the inflation forecast targeting. That's the Swenson kind of thing.
Well, but it's not a forecast anymore. It's literally the target. Because you should have got back to the target, right? So, in a sense, is that an informative forecast? Or I think it's probably more informative to see what the forecast was that went to the board. And that's the one that the actual RBA published historically, what actually went to the board, rather than what is based upon the interest rate decisions. But I raise this because there are obviously, as you even mentioned, there are many types of forecasts that people provide, and they all revolve around, do you take the policy changes into account or don't you? And you get enormous variations in. If you look at the Bank of England, for example, and the inflation fan charts, I mean, the inflation fan charts are really not so much a forecast of inflation, but they're about the sensitivity of what the inflation forecast would be to risks. In particular, they identify 3 major risks that could happen, and they attach probabilities to that, and they give a spread, therefore, of what the things might be. But it's not actually what will happen. I mean, it may be quite a long way away from what will happen, because none of those risks might actually eventuate. So,
you mentioned the Bank of England, and I should mention that you were hired to do a review of the modelling framework of the Bank of England. This is the only person. And so can you just maybe tell us a little bit about the process and what your findings were? And I know that you had some quibbles about one of the models they were using.
Well, they wanted me to come in and look at the existing models and the existing methods they were using for forecasting, and particularly at that time they were building a new model, and they wanted me to comment upon whether it was state of the art. And state of the art doesn't mean the highest academic standards, because no central bank model really tries to be at the frontiers. It uses things that are being tried and true, and so my job was to sort of answer the question from that perspective. And in the monetary policy department at the Bank of England time, I think had 134 people in it. So, as you might expect, it was pretty close to state of the art. I don't think there was any doubt about that. And I basically made some various suggestions, both in my final report and as the report went along, about what they should do. Some of them they agreed to and they put into the model, and some of them they didn't, and they left it out. And so, it was the standard type of thing you do when you go and look at central bank models and make some comments upon them.
So is there, going back to transparency, is there anything that central banks should not publish in your view? I mean, one of the question is whether the minutes of the meeting should be published, or even the voting records, whether attributed or non-attributed. What's your view of that?
Well, I don't think I'd like to see the voting records published. I think that just produces more froth and bubble in the commentary on monetary policy. The newspapers, I think, are full of froth and bubble today about economics commentary, and trying to guess who will vote which way in the next round. I think is really not a good use of our time or even, and the public shouldn't really be constantly bombarded with it.
And it may also put pressure on the individuals to maybe vote in a certain way.
Well, I think it can. Mervyn King used to have, who was a governor, or still the governor of the Bank of England, had the nickname of Merv the Swerve because he once changed his opinion about which way the interest rate should go from one meeting to the next, and I think it took him a long time to live that down. But I just don't see that this is actually terribly useful information. That, I mean, you definitely need a documentation on why you made the decision. It has to be precise, and but it's like a cabinet decision. That I think it should be like a cabinet decision. That, you know, and basically there's a governor speaks and announces what it is and why they did it, and what exactly the board members felt about it is something else. If you don't do that, you'll end up with people trying to work out by inviting the board members along and giving them a good dinner and some good wine or something. You might find something might slip, you know, and I just think this is crazy, actually.
So let's move into the more recent past and also the future. So to the global financial crisis, central banks responded with a lot of monetary stimuli, basically lowering interest rates almost all the way to zero. How do you think that was successful, and what are maybe the tools that central banks can use once interest rates are at zero?
Well, I think the quantitative studies that have been done on quantitative easing would suggest that it actually has in fact been quite effective. And you know, there have been quite a lot of studies done on the American QE2. There have been some studies done on the Bank of England. There have been a few studies done fairly recently on Europe, I mean, with the recent changes. And I think they all show that it did have a positive effect certainly upon output anyway at that time. I don't see that. It seems to me that the question is the wrong question. The question is not what monetary policy can do. It's that monetary policy is never a strong instrument to work with. It has effects upon output and inflation, which are fairly weak actually. You need to make big monetary changes before you have effects. And I think the zero bound problem that we ran into shows that. I mean, that even if you cut it down towards zero, you can't have much of an effect. And what we really need to think about is its fiscal policy. Fiscal policy has much stronger effects, and just thinking there's only one instrument out there and that's the interest rate is going to get us into a lot of trouble if we continue to do this.
And fiscal policy, in fact, seems to be much stronger in an environment where interest rates are at zero. I mean, we had the recent IMF confession that the fiscal multipliers they work with are much lower than what seems to be the case now in the global financial crisis. Yeah, I think there may be a case for fiscal policy as a substitute. But let's go back to quantitative easing. How does it work? What is that about, or what are they trying to? What are the central banks trying to do?
Well, in many ways, quantitative easing, of course, is on the broadest level just changing the amount of liquidity or the amount of money in the economy. But how you do it can vary a great deal. I mean, you actually have to go in the market and buy some assets to do that, and the question is what type of assets you buy. And that's been one of the distinguishing features of the quantitative easing that's happened in the last few years, is that there's been a huge variation in the way central banks have done this. Some cases they've bought bonds, and some cases they've even bought equity. I mean, so you know, these have different effects. Sometimes they've bought troubled assets, sometimes they've bought assets that aren't so troubled, and you know, but the ultimate effect, of course, is to affect liquidity and to affect money. And one of the biggest problems with QE has been that there's been an awful lot of hoarding of liquidity and money, and US companies, for example, have got huge amounts of liquidity, and they haven't actually spent, as you might have expected they would. So they've just exchanged one asset for another.
Now, the issue now that people sometimes talk about is the fact that quantitative easing has basically tripled, or all these various type of unconventional monetary policy has basically tripled the Fed's balance sheet. And the question is, some people think it's just printing money, which I think is obviously not quite accurate, because as you say, the money hasn't really made its way into the economy. Most of it is just sitting on the commercial bank's accounts with the Fed. But will it eventually be inflationary, as some people fear?
Well, I think you have to realise that every year we have an enormous change in the money supply at the end of the year, and that's due to Christmas. Every Christmas the Reserve Bank goes out there, basically buys assets, supplies money to the banking, to the public. I mean, the public use that to buy things for Christmas, and then at the end of that period of time the Reserve Bank goes back in and sort of sells the assets again, right? And so if you actually took a deseasonalised measure of money supply in Australia, you'd see a huge rise, in that quarter. Yet that doesn't cause any inflation in the December quarter. See, the liquidity has to have an effect on expectations. No one expects that because money rises around Christmas, that this is going to affect inflation. For two reasons. One is that it's a response to a demand that people are making. And the other reason is that they know that this is going to be reversed. Within a month or two. And I think that's the issue with the amount of liquidity. Does the central bank that is supplying all this liquidity have credibility that when the time comes to actually rein back liquidity, it will act quickly and responsibly? Or doesn't it? One of the arguments for an independent central bank is it's got more likelihood to do that than one that isn't independent.
Well, the issue now, it seems to be a lot of talk is the Fed's exit strategy. Exactly, you mentioned the kind of winding back all this liquidity. And what the Fed was authorized to do by Congress in late 2008, I think, was to pay interest on these excess reserves that commercial banks hold with the Fed. And what they're trying to do, or what they're thinking of doing, is when, if the banks would have a temptation to release the money into the economy, the Fed can always raise this interest so that they can always suck out all this liquidity. But it's never really been tried before, and there's a lot of questions of whether, politically, whether they have the courage to do that, because it will have some negative effects on growth and so on. So do you think they can maybe pull it off? The Christmas story is kind of much easier to do than dealing with tripling in your balance sheet, right? Or do you think that doesn't matter? The magnitude is not a problem of kind of winding back these excess reserves?
Well, I think that people can rein in liquidity fairly quickly, and I don't see it as an issue about having negative effects on growth, because if liquidity is causing demand to rise very strongly, then you would want to pull it back. That's one of the key things, that a central bank has to look at what's happening to demand all the time, and it then has to respond appropriately. In 1994, when the Reserve Bank was widely regarded in Australia as being rather weak on inflation, very, very soft on inflation. And a few journalists actually wrote that they were an extremely wimpy organisation. And in 1994, when demand suddenly looked like it was taking off, very strong demand things, the bank put up interest rates, if I remember rightly, 250 basis points. And that stopped the demand in its tracks. As much as slowing things down, stopping their tracks. But certainly within the year, demand was back down to a reasonable growth rate. And that, I think, gave the Reserve Bank a lot of credibility, because basically it was the first test of them as an independent central bank, effectively, and they reacted to it appropriately. And I think I think that could actually be done in the Fed as well. I don't see any reason why it wouldn't be done. So I'm not so concerned about all the liquidity that's out there. I think you can respond to it because you know what you're looking at. You can see the liquidity there. You can actually see that there's a potential for very, very strong rises in demand. And because you see that, it's actually a lot easier to deal with. It's when the things you don't see that you find it very hard to deal with. And again, it's like driving a car, that the things that you can see happening ahead of you, you can respond to. The things that come in from the side that you can't see, or the things that you can't see in the black spot in the rear vision mirror, they're the things that get you in the end.
Well, I would agree with you that the current kind of liquidity measures is not so much of a concern. The bigger concern is probably the long-term fiscal development, aging populations, and the kind of fiscal pressures that there is some literature, Sergeant Boller's Unpleasant Monetarist Arithmetic and Lieber's fiscal theory that basically say these kind of actions might eventually spill over and jeopardize the outcomes of monetary policy. Would you think it's kind of like a longer term danger?
Oh no, I think that is a longer term danger. I mean, coordination of monetary and fiscal policy is really a tricky problem, and in many ways you'd like it that there was some independent body manipulating some of the instruments of fiscal policy in order to be able to sort of stop that type of thing. I mean, the Business Council some years ago suggested that the GST tax rate could be changed by 1 or 2% by a body that was independent of the Treasurer, which would actually aim to stabilise the economy. Essentially was fiscal policy, was flexible fiscal policy. So I think that it'd be good if we can actually come up with some more automatic ways of adjusting fiscal instruments.
We had Don Brash, the governor of the Reserve Bank of New Zealand here last year, and he had a similar suggestion. He would be using the taxes on petrol flexibly as an additional instrument of monetary policy. But again, there are some maybe implementation issues.
I think that's too narrow a tax, though. I mean, the GST is a good one to vary. I mean, for one reason, it's automated already into accounting systems, so you could raise it from 10 to 12%. Their suggestion wasn't that you could raise from 10 to 50%. It was you had like plus or minus 2%, if I remember rightly. And I think that actually was a good idea, but politicians are very reluctant to give up control over these things. Those things that you mentioned, Social Security in America could probably be solved by relatively small rises in tax rates, actually. I don't see that as a longer term issue really there.
But I have to disagree with you here because I've done a lot of research on this. There's a recent IMF paper that basically estimates the size of the fiscal gap in the US and shows that if you were to raise taxes, you'd have to increase taxes by about 60% across the board to be able to close the gap. But we're rapidly running out of time.
We'll argue.
We'll argue over
Yes,
lunch. But can I just ask you about some of the lessons that maybe we can learn about monetary policy from the recent experience from the GFC and also maybe thinking about the inflation targeting framework and whether we need to modify it in terms of taking asset prices into account more explicitly or something like that, as many people argue. What's your view on the lessons?
Well, I think the lessons from the GFC, the ones that one learns every time we have a credit crunch. I mean, as I said, in 1974 we had a credit crunch, so people then spent a lot of time looking at what was happening to credit and stresses on banks for almost a decade, and when that didn't happen again, they decided to forget about it. I mean, the problem is that when you're doing monetary policy, you're always looking at the last war. And you've actually got the instruments to handle the last war, but the next war is going to be a very different war to the current one. And one of the things I said in the review of the Bank of England stuff is that you should always be preparing for the next model. No, you shouldn't stick to one model. You've always got to have an eye out for what are the things that are going to kill you in the future, and you have to think about modelling to handle that. Obviously, what we're seeing now is all the models and the thinking's adjusted to introduce financial factors into them and to look at a wide range of spreads. It's not that people didn't look at these in the old days, but they didn't look at them as closely as they probably do today. But that's probably not where the next crisis will come from, actually. So,
what about the future of inflation targeting? Should we look at a broader measure of inflation than just the consumer prices?
Well, I think consumer prices, we look at those because they're the things which affect households and they affect ultimately the amount of welfare. If the CPI wasn't broad enough to do that, then you'd want to change it. But I think it's very difficult to change something like the CPI. I looked at this some years back, and it is amazing how many contracts are indexed to it in law. And it'd be an enormous job. I mean, just actually introducing a new index that would actually might be better or worse for monetary policy, depending on whether people could understand it or not, just because we'd have to go through all these legal changes. And I'm not sure that there'd be any real benefit from it in the long run. If you think of the introduction of the ASX into Australian stock markets, I mean, we still see the All Ordinaries. I mean, despite this other superior measure of stock prices. And I think we'd find that the CPI would just continue on, and we'd end up with two indexes, and it wouldn't be clear which one we should in fact be looking at. So I'm in favour of just staying with the CPI.
What about the idea of maybe changing the inflation targets temporarily in certain points in time? Currently, people like Paul Krugman and others argue that, especially for the Eurozone, because of fixed exchange rates, we really need to raise the inflation target temporarily, say to 4 or 5% for 5 years, in order to be able to avoid deflation in some countries like Spain and Ireland. Do you think that changing the inflation target in some ways might be beneficial?
Well, it may be, but I'm not sure that's true in the case of Europe. If you think of Spain, for example, the problem is the long-term rates, not the short-term interest rates. It's the long rates which are actually creating all the trouble. And if you raise the inflation target, it'll just get built into the long rates, so that I think it's, the fiscal issues there are really the problems rather than the monetary policy issues. I mean, I think the ECB was a little slow at stimulus, but I do think now that they've actually pretty much got that. They're in the right direction now, and so I can't see any reason to raise the target inflation rate actually.
Okay. Now the last question before we hand it over to the audience for questions. What about macroprudential policy? Do you think the central bank should be involved in that? There seems to be kind of a model where some countries like Australia have a different agency, a different institution for that. Some countries it's the central bank looking after macroprudential policies and bank regulation. What do you think is the right model?
I think it depends on the on the countries. I mean, I think in a large country, I think there's an argument for having them separated. In a small country, I think there's less of an argument. The problem you're always going to have if you have different organisations doing prudential stuff and from monetary policy is just how you do the coordination. And that's not an easy task. If there's going to be lender of last resort things, it's the central bank that's got the checkbook, and the regulating body doesn't have the checkbook. So somehow or other you have to coordinate these things, and that's something I think which we've done pretty well in Australia. Because of that, I would be in favour of a separation in Australia. I don't see any arguments for. I think there's I think there's good arguments anyway for the central bank to focus on monetary policy, and for a different body to effectively focus on prudential policy, but there to be very, very close cooperation between them. I think in the Bank of England, for example, where the Bank of England supervises, they're actually setting up a prudential committee basically, which is going to sort of effectively do things that the Monetary Policy Committee may have done in the past. I think it's very difficult to cover all of those things in one body actually. I mean, so it's a good idea to separate them out. But in very small countries, I think it would just be too costly to do that.
Okay, thanks. So, can I please invite the students for questions? Are there any quick questions, Chris?
All right. One's kind of oh God. Before the 2007 election, there was a bit of a debate between inflation in Australia between the two major parties in regards to bananas. One side said that inflation was caused predominantly by bananas. The other said it wasn't, and that interest rates were going to have to rise. How do you reflect on this? Do you think that bananas was the problem? And if so, do you think the removal of trade barriers could help with monetary stability?
meaning if you are allowed to import more bananas.
Bananas in Australia are protected by tariffs and that, and you can't import them from
Well,
Philippines.
they're not tariffs. There's quarantine regulations, actually, not tariffs that protect bananas. Well, that's tricky because if it's quarantine, then it's not something you can vary according to monetary stability. I wasn't actually here in 2007 when this all occurred, but you can see in the CPI if it's due to bananas. If it's due to bananas, you know the price will actually go back down again, at least in a year's time. So it's not the type of thing that you would actually respond to, and that you shouldn't expect the central bank to respond to. I mean, it's just like GST. I mean, inflation may have gone up, but it'll go back down again, and therefore doesn't call for monetary action. I mean, so I'm not. I mean, anyone who said that the way you read it out, it sounded like there was some doubt about whether inflation was caused by bananas or not. I mean, that's just a matter of what the CPI says. So, and there was in fact an increase in the inflation rate, and that was due to bananas.
So I think it was more the magnitude of so the inflation was rising.
Yeah.
But they were trying. One party was saying that it was predominantly due to the inflation caused by bananas, whereas the other party was saying that.
I mean, political parties are always going to choose the argument that most appeals to them. But one of the arguments for why Australia has a flexible target is that you can run above the range that we normally operate between 2 and 3 to accommodate things like banana price rises. And at that point in time, 2007, the Reserve Bank was increasing interest rates, and it was because there were other signs of inflation, and not so much the CPI as it was coming out in terms of wages. There was very strong wage growth in various sectors because demand was growing quite strongly, so you were naturally going to raise interest rates at that point in time. That was early 2007, if I remember rightly. So I'm trying to think back on. I remember I was giving a talk about something in at the time the Economic Society, and that was the only question I got asked was, why did I think interest rates were too high? And I said at the time that I thought that raising the interest rates at the time was a good thing to do because there was signs of wage growth that would end up with inflation, and subsequently, of course, when the global financial crisis hit, the interest rates were quite high, and so they could reduce them a long way. I mean, and have quite an impact upon the Australian economy as a result.
Okay, maybe another question.
How do you go about defining a shock? Say, like a natural disaster will be a shock, but just say throughout the month you get all this data, and you expect unemployment's going to be like this, you expect retail sales are going to be like this, and then you realise that, okay, retail sales, for example, are much above expectations or below expectations. Is it because it's below expectations you classify it as a shock? And then how do you go defining about responding to like interest rates? Like, because you do want to plan the pathway of interest rates. So how would the board go about saying, okay, this is a shock because it is out of our forecast, and how should we respond to that?
Well, I don't think if you look at any monthly series, I don't think the board would seriously take too much notice of variations in a monthly series on employment or credit or virtually anything else. I mean, it has to be sustained for some time, and that's not really then a shock. The sort of shocks that I'm thinking of are things like the Asian financial crisis back in 1998. That was a shock because there was no real reason for why it should happen. I mean, if you looked at exchange rates at the time, maybe they were 10% overvalued amongst, in Thailand, etc. But suddenly, all the people rushed to the doors, and there was a terrific shock. I mean, it was something that was totally unexpected. And there are lots of shocks like that. I mean, but they're not the variation in monthly statistics. I don't think is a shock. The best example I know of variation was once there was a huge drop in imports into Australia in 1 month when I was on the board, and the financial journalist wrote this up as this was evidence the Australian economy was sinking, because imports are collapsing and therefore demand's going down. And the Reserve Bank spent a lot of time looking at this, and what they discovered was that this was the March quarter. Easter fell in March that year. all the imports had come in, but all the people who write out the invoices to record them had all gone off on Easter holidays, so they didn't get recorded in March, they got recorded in April. So this month it goes down, the next month it went up by a long way, and that's the type of thing that happens with these statistics, monthly things all the time. And you don't call them shocks, you just think that, you know, there's something peculiar in this thing, and trying to find out what it is a key thing that the bank does. And the bank has a lot of people who are very good at this type of thing, and far more than the private sector does. So I think one of the questions you were thinking of asking was, should the bank release all the information they have? And I don't think there's much that they don't release. What they have is a lot of people analysing data that most of the private sector doesn't have, and because of that, you know, they actually are much better equipped for analysing it rather than, you know, I mean, you know, in many ways you also asked about the Secretary of Treasury being on the board, and what the Secretary of Treasury brings, of course, is all Treasury's experience at analysing the data as well. So, yeah, I mean, it's data analysis that the bank has, and that's not the sort of thing you can actually release, because there'd be reams and reams and reams of it. Lots of things that get done that no one would ever want to read. Mostly they're just minute. I mean, I work in the bank every now and then, and you know, when I go in, I have an account there with my emails that come in from people around the bank, and there must be hundreds and hundreds since the last time I was in there, and you know, lots of times they're little minutes about some data or something that you know, someone's analysed, but you wouldn't want to release all that because most of it is just, you know, it's here today and gone tomorrow.
Cheap talk. Now, you mentioned the Secretary of the Treasury being on the board of the Reserve Bank, and that's a bit of an anomaly in Australia, and some people worry about the fact that it might compromise the independence of the RBA. You know, it might bring the expertise you mentioned, but again, maybe the independence issue is something to worry about?
Well, there's, you know, it's the Secretary of the Treasury sits there as the Secretary of the Treasury, not as the representative of the Treasurer. And I think he takes that very seriously. And he presents effectively another view about, or it might be exactly the same view as the bank has, but it's potentially another view, and it's based on quite a lot of analysis that Treasury has done. And I think that it's been actually a very good thing. I mean, you might also think it would help with coordinating fiscal monetary policies, but I don't think it's actually ever done that. But you know, I think it's just that no one else pretty much on the board has got the same level of support, the same level of information and capacity to analyse things as what the Secretary of Treasury does. You know, I mean, the academics who sit on the board, you know, you have to do it all yourself. You don't get a big budget and a team of people to work for you, so it's inevitable that sometimes you may not be as effective as you might hope to have been.
We might have time for one last quick question. I just wanted to ask you about the Eurozone quickly, just looking forward. Do you think that we're going to have a resolution anytime soon, or the current stress? And do you think the Euro will survive in its current form?
Well, actually, I'm not really an expert on the Eurozone. I felt that Greece should have gone a long time ago, but that's about I mean, I just think it's virtually... But I'm not so sure anymore. I think, you know, they've invested a tremendous amount into keeping Greece in, and they may have to follow through with it. I actually think the Euro will survive, actually, yeah.
Okay. Well, Professor Adrian Pagan, thank you very much for your insights and sharing all your expertise with us, and we'd like to wish you all the best for the future. Thank you.
Thanks.
Please give Adrian a round of applause. Thank you.